Financial market manipulation refers to deceptive and unfair practices aimed at influencing the price or trading volume of financial assets for personal or institutional gain. These activities distort market integrity, undermine investor confidence, and can lead to severe economic consequences. Market manipulation occurs across asset classes, including stocks, bonds, commodities, and cryptocurrencies. Governments and regulatory bodies worldwide have established rules to combat these practices, but manipulation continues to evolve alongside market structures and financial instruments. Market manipulation generally falls into two broad categories: manipulation of market prices through trading strategies, and manipulation through the dissemination of false or misleading information. Common types of market manipulation include pump and dump schemes, spoofing, insider trading, wash trading, and bear raids. Pump and dump schemes are a form of financial market manipulation in which the price of an asset is artificially inflated through deceptive or coordinated means before being sold off at a higher value, leaving unsuspecting investors with losses. These schemes are prevalent in stocks and cryptocurrency markets, particularly in assets with low liquidity and market capitalization. The process begins with promoters or individuals accumulating large positions in an asset at a low price. They then generate artificial hype through misleading statements, exaggerated claims, or coordinated buying, often leveraging social media, online forums, or even fraudulent analyst recommendations to attract retail investors. As the price rises due to increased demand, the perpetrators sell their holdings at an inflated price, securing significant profits. However, once they exit their positions, the asset value collapses, causing heavy losses for those who purchased at peak prices. Pump and dump schemes thrive in unregulated or loosely regulated environments where oversight is limited. Cryptocurrency markets, in particular, have witnessed a surge in these fraudulent activities due to the anonymity of participants and lack of stringent regulations. Certain obscure stocks or newly issued tokens are especially vulnerable to manipulation, making them prime targets for scammers seeking quick gains. Financial spoofing is a deceptive trading practice in which market participants place large orders with no intention of executing them, creating a false impression of demand or supply to manipulate asset prices. Spoofing disrupts market integrity by misleading other traders into reacting to artificial order flow, often benefiting the perpetrator at the expense of legitimate investors. Spoofers is the practice of placing sizable buy or sell orders to influence market sentiment. Once other traders adjust their positions based on perceived demand or supply, the spoofer cancels the fake orders and executes genuine trades at more favorable prices. This practice can be used to push prices higher or lower, depending on the spoofer's objective. High-frequency traders sometimes engage in spoofing to exploit price inefficiencies within milliseconds, making detection challenging. Advancements in artificial intelligence and algorithmic surveillance have improved detection capabilities, enabling exchanges and regulators to identify abnormal trading patterns indicative of spoofing. Financial institutions deploy monitoring systems to prevent manipulation and maintain fair markets. Investors can protect themselves by avoiding assets with unusual order book activity and remaining cautious of sudden price movements driven by large order placements. Despite regulatory efforts, spoofing persists in various financial markets, including stocks, commodities, and cryptocurrencies. Strengthened enforcement measures, combined with investor awareness and ethical trading practices, are essential in curbing this deceptive tactic and preserving market fairness. Insider trading refers to the buying or selling of securities based on material, non-public information, giving an unfair advantage to those with privileged access. This practice undermines market integrity and erodes investor trust, as it creates an uneven playing field where insiders profit at the expense of ordinary investors. Insider trading is illegal in most jurisdictions and is subject to severe penalties, including fines and imprisonment. The pending Pelosi Act, formerly known as the Preventing Elected Leaders from Owning Securities and Investments Act, aims to address concerns about insider trading among members of Congress and their spouses. Named after former Speaker Nancy Pelosi, who faced scrutiny over her husband's stock trades, the act seeks to ban lawmakers and their spouses from trading individual stocks while in office. Instead, they would be allowed to invest in diversified mutual funds, exchange-traded funds, or U.S. Treasury bonds. Lawmakers would have 180 days to divest their holdings or place them in a blind trust upon taking office. Violators would forfeit any profits to the U.S. Treasury and face additional penalties. The Pelosi Act reflects growing bipartisan support for stricter regulations on financial activities by elected officials. Proponents argue that it would reduce conflicts of interest and restore public trust in government institutions. Critics, however, question whether the act goes far enough to address broader issues of transparency and accountability. By targeting insider trading and potential conflicts of interest, the Pelosi Act represents a significant step toward ensuring ethical behavior among lawmakers. Its passage could set a precedent for similar reforms in other sectors, promoting fairness and integrity in financial markets and governance. Wash trading is a form of market manipulation in which a trader or entity simultaneously buys and sells the same asset to create an illusion of market activity without any actual change in ownership. This deceptive practice inflates trading volume, misleading investors into believing an asset has strong demand or liquidity. Wash trading is illegal in most regulated financial markets, but it remains a persistent issue, especially in unregulated or loosely monitored environments such as cryptocurrency exchanges. The primary objective of wash trading is to mislead market participants into making investment decisions based on false market data. Traders engage in wash trades to attract investors by making an asset appear more active than it actually is, driving artificial interest and price movements. Some entities use wash trading to meet exchange listing requirements, manipulate asset rankings, or trigger algorithmic trading responses. Despite regulatory measures, wash trading is still prevalent in cryptocurrency markets due to the decentralized nature of many exchanges and the lack of standardized oversight. Some crypto exchanges have been accused of engaging in wash trading to boost trade volume metrics and attract users. As awareness increases, investors and analysts use blockchain analysis and market surveillance tools to identify potential wash trading schemes. Bear raids are a form of market manipulation in which traders or investors deliberately drive down the price of a stock or asset through aggressive short selling and spreading negative rumors. The goal of a bear raid is to create panic among investors, triggering a sell-off that further lowers the asset's price, allowing the perpetrators to buy it at a discount or profit from short positions. A bear raid typically begins with traders taking large short positions in a stock, betting that its price will decline. They then spread negative information, whether true or misleading, through financial news, analyst reports, online forums, or social media, influencing market sentiment. As panic spreads, investors start selling their holdings, exacerbating the decline. Once the price drops significantly, the bear raiders close their short positions at a profit or accumulate shares at a lower valuation. Bear raids can be particularly harmful to smaller companies with lower liquidity, as their stock prices are more vulnerable to manipulation. While bear raids are not always illegal, deliberately spreading false information to manipulate prices constitutes securities fraud and can result in legal consequences. Regulatory authorities such as the U.S. Securities and Exchange Commission, SEC, Commodity Futures Trading Commission, CFTC, and European Securities and Markets Authority, ESMA, impose laws to prevent and penalize manipulation. Various pieces of legislation, including the Securities Exchange Act of 1934, have established rules against fraudulent market activities. Financial firms and exchanges have also implemented surveillance mechanisms, utilizing artificial intelligence and advanced analytics to detect unusual trading patterns indicative of manipulation. Despite these efforts, market manipulation remains prevalent due to the complexity of modern financial markets. High-frequency trading, HFT, and algorithmic strategies have made manipulation more sophisticated, enabling traders to exploit price inefficiencies at milliseconds' notice. The advent of decentralized finance, DeFi, and cryptocurrency markets has also opened new avenues for manipulation, with reduced oversight compared to traditional financial markets. For example, crypto markets often experience pump-and-dump schemes driven by coordinated efforts within online forums and social media groups. The impact of market manipulation extends beyond individual investors, affecting broader financial stability. Manipulation distorts asset valuations, misallocates capital, and creates artificial bubbles that can ultimately lead to market crashes. In extreme cases, market manipulation has contributed to financial crises, such as the manipulation of interest rates during the LIBOR scandal, where banks falsely reported lending rates to benefit their positions. Investor education and regulatory vigilance are key components in mitigating market manipulation. Investors must remain cautious, verify information from credible sources, and recognize warning signs of potential fraud. Regulators continuously evolve their frameworks to combat manipulation, implementing stricter policies and leveraging technological advancements to enhance market surveillance. Financial institutions also bear responsibility, ensuring compliance with ethical trading practices and fostering transparency. Market manipulation is an ever-present risk within financial systems that requires collective efforts from regulators, financial institutions, and market participants to mitigate its adverse effects. By promoting transparency, improving enforcement mechanisms, and encouraging ethical investment behavior, financial markets can operate with greater fairness and stability. Check out our other videos to learn more about how to become financially free.